Good morning and welcome back to Almus Market Mornings. Today, April 2nd, marks a pivotal moment for global markets as US reciprocal tariffs announced by President Trump take effect. These tariffs target multiple countries, potentially reshaping international trade dynamics and market sentiment. Traders worldwide remain on edge, closely tracking how these measures may affect economies, currencies, and trade relations. JK, with the global tariff implementation just 17 to 18 hours away, what do you see as the immediate market impact and how can investors best navigate the uncertainty ahead?
Morning, Suraj. First of all, wishing everyone a very prosperous new financial year. Yes, I think what the market is looking for or itching to get is some clarity and removal of uncertainty because there has been so much of contradictory narratives emerging around the scope, scale, and duration of the proposed trade measures that investors are actually trimming risk across currency markets as well as other risk assets. That's what we have seen in the past few days, particularly in the stock market. We have had big falls in the US markets and followed by other markets as well. So now what we can expect, it's very difficult to predict because there have been so much of flip-flops in earlier instances. Now it can swing from one extreme to the other. One extreme says that media speculating that 20% tariffs across and all the countries apart from the specific tariffs that he has announced. That's one extreme. The other extreme is that the most optimistic is that once again he may borrow time and say that this can be postponed to another month or two. So I think that's a more unlikely scenario. But whatever it is, we are looking for clarity. And ahead of that, definitely there has been a lot of volatility in the stock market, in the equity market, so in the bond market, as well as in the currencies. The currencies being lesser of the volatile, segments. Of course, amid all this talk about tariffs, it has overshadowed the economic data, but it cannot be actually ignored because the Friday's data was very important. PC data showed acceleration in core inflation, including uptick in the core, in the super core also, and the market was more concerned with the decline in spending by consumers, and that is actually pointing to a more certain emergence of stagflation in the US. In fact, we have had another investment backer, pointing to a 35% probability of stagflation in the US in the coming year. And in fact, the GDP one, sorry, GDP now estimates are now going above -3% based on the latest data that we have seen. GDP now is well, it's not an official publication, but it is closely followed by being published by a research house, and it is steadily showing a negative growth for the US in the coming quarter, and the latest data have only added to that. Beyond the PCE data, we also saw the University of Michigan consumer data reaffirming that consumer is not happy. Inflation at the same time, inflation expectations soared further, and the data definitely on the face of it says that the economy may be headed to stagflation, and this led to a big fall in the treasury yields. In fact, the US 2 year went down to as low as 3.84%, and the 10-year came down to 4.15%, although they have since then bounced a bit. But definitely, I think the safe haven buying in the treasury was very clear, even as the stocks sold off, and gold also, of course, gained. Apart from the Friday's data, important data yesterday was also notable because we saw much lower job openings as per the JOLTS data at 7.56 million, and this is as against the 7.74 million that was reported in January, and even well below the market expectations. The quit rates are also coming down, which means the employees see the quit rate fall, as a indication that their ability to find equally good jobs are less, And also at the same time, employers also see it as an opportunity to keep the wages steady, because if the employees are sticking on to the jobs, there is no need for the employers to increase. So that means wage inflation will be lower and consumption also will get affected. So all in all, much of the data has been on the softer side. Yeah, I just did not touch upon the ISM manufacturing index, which dropped to 49 from 50.3, lower than 49.5. Yes, it is back in the contraction territory after being in expansion territory for 2 months. And more worrying is the fact that it is showing lower employment, no lower new orders. At the same time, the prices paid have soared, in fact, to 69.4 from 62.4. So again, indication of a stagflation. So overall, the picture emerging from the US economy has not been good for the risk assets, and that is clearly reflected in the markets as well. So add to all these, this uncertainty about tariff. If the tariffs do come as expected at 20% across countries, and I think they are sealing the growth for the next few quarters. Administration, and of course by their own statements, they are okay with short-term pain as they go in through a lot of structural changes. So anyway, we will know all the actually clarity will emerge in less than a day. In fact, to be precise, at 12:30 a.m. India time, the announcement will happen by Mr. Trump from Rose Garden in the US. So that's what we are looking forward to. As far as the dollar movements are concerned, if you look at the overall behavior of the dollar now compared to, let's say, a year back or even 6 months back, all these risk-off scenarios were leading to a long dollar scenario, but that is completely changed now. Now we are hardly seeing any big rise in the dollar against any currencies, even including Canadian dollar and the Australian dollar, which are affected by the tariff threats. We are seeing dollar quite steady, in fact, weakening against gold. And of course, so the treasury yield movements are keeping the yen volatile. So overall, dollar is still on a weaker footing, I would say. And once the clarity emerges on tariffs, I think we will see whether dollar regains, if there is a bigger risk of sentiment, or if there is some sort of a relief in the tariff announcement, we can probably see the dollar fall much more in the coming days. That is the scenario. And as far as India is concerned, I think the uncertainty is equally high. We have had a large movement in the dollar rupee last week. And I would say it was an exaggerated move to the downside by the USD INR, in view of the fact that there were bunched up inflows, absence of central bank buying, and also some sort of a lack of buying by other participants in the market, waiting to see if we get better rate. That is how it always happens. When it was going up, exporters were holding back, thinking that it will weaken more, and when it is coming down, the importers are now sidestepping themselves, waiting for better levels. But I think we have seen an extended move, which may correct itself for two reasons. One is the uncertainty of the tariff. If you look at the stock market yesterday, there was a big slide, and then we also had the FII flow turning negative yesterday. That demand also can come. And with all the talk about the macro improvement, the RBI eventually will look to rebuild some of their reserves, at least to meet their big forward liabilities. And so at some point, expect, even if there is a selling, it can be absorbed by the RBI. And also with the passing of the financial year, I think the pressure to sell dollars will be much less. So I think if dollar does start at lower levels like 80, 85, 50, you'll see some good buying coming in there from all quarters. And eventually, by the end of the day, I won't be surprised even if we inch towards 85, 90 or so. And then we'll take the cues from the Trump announcements, which will be coming overnight. Yeah, that's it. Thank you. And once again, wishing all the best.
Thank you, JK. And I think just a quick summary of the data from the US economy. The major theme is, of course, the data has been softer. If we look at whether we look at the ISM number, whether we look at the Friday's PCE data, which showed acceleration in core inflation, or the GDP now, which is showing degrowth by over 3%. So basically, higher inflation, lower growth, so some sort of a stagflationary situation, and that's the theme major reports are also covering. The tariff related impacts would be separate. The announcement is at 12:30 a.m. Indian Standard Time. For the currency markets, currently no big dollar rise despite the risk of sentiment. Dollar is quite steady. Yen remains volatile due to the volatility in US yields. And for India, we saw a very large movement in USD INR last week, bunched up inflows and lack of intervention by the RBI. Saw a good amount of rupee appreciation. But as JK mentioned, the move is quite stretched and the possibility of correction is there. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.